There is trouble in our economy. There's trouble with jobs. There's starting to become trouble with real estate, especially commercial real estate and other aspects. Businesses slowing in certain sectors, certain types of companies. And this is starting to happen more and more systemically. I'm going to talk about a story that involves commercial real estate, and I'll explain. My name is Ben Repond. Today is May 14, 2024. Thank you for watching my YouTube broadcast. The picture of this building is Burnett Plaza. That may not ring a bell to you, but Burnett Plaza is in downtown Fort Worth, Texas. Now, Fort Worth is not Dallas or Atlanta. It is a smaller market, but it is still part of the Dallas-Fort Worth Metroplex. And it is a growing city. And anyway, this is the largest building in Fort Worth. It's been there for a number of years. I saw this article where this building went into foreclosure and they sold it out of bankruptcy on the steps of the courthouse for $12.3 million. $12.3 million for this building. 3 years ago, according to the Dallas Business Journal, 3 years ago, it sold for $137 million. It was recently appraised at $104, but the top bidder was $12 million. Wow. That is 9 cents on the dollar. A discount of 91% for that. What that tells you, what it tells me, is that commercial real estate is beginning to collapse. I've covered this the last few weeks. It's beginning to collapse for a number of reasons. One, work from home. People working from home, a lot of those offices are empty or could be greatly downsized. There is a requirement for the owner to carry a lot more of the equity, and the interest rates have gone up from very, very little, almost nothing, to up around 5%. And they have to refinance these every 3 to 7 years, depends on the deal. You could say an average is about every 5 years they have to refinance it. Very different from your home, where your home you lock in a 30-year mortgage or 20-year or whatever you do. And so those are the three factors that are pushing the price and the demand for commercial real estate down. But when I saw this, 9 cents on the dollar, it just shocked me. So, I mean, this is below what I think anybody ever expected. I don't even think the people who were bidding on it thought their bid would be accepted. Wow. But it tells you something. This is telling the story about what's going on with jobs in some markets, many markets, and is what is also going on with commercial real estate. As that happens, it starts to reverberate throughout the economy. Next, I want to play a piece from Adam Taggart. I watch Adam Taggart. He's a very good interviewer and has some interesting guests on. And in this case, he had Melody Wright on. She is a writer for the Financial Times, and he saw a piece that she did for the Financial Times regarding the Freddie Mac getting involved in the home equity market, the secondary market for home loans. So second loans, home equity. That has been commercial lenders, banks, have been the ones that have been getting into that. And now here you have the government potentially, or a government-backed organization, coming into the lending business. That has not been there. The implications of this is that as people, if they could go through Freddie Mac to get a home equity loan, they could make it so that people could tap into, he says, $1 trillion right away. $1 trillion of home equity that's out there, and as people are hurting, rather than going to their credit cards, they could go into their home equity. Or, he says, up to $2 trillion, and this is quickly. So he says this will be a stimulus to our economy, which I agree it would be. It'd be like kind of free money, so to speak. But the implications are it would be inflationary. And it would kick the can down the road so that people would think, you know, I'm now got a reprieve, I can pay off my debts, I can pay off my credit card, etc. And people think they're doing well again. When in reality, what that loan does is it gets tacked onto the end of your primary loan, your first mortgage. So when people go to sell their homes, they think, oh, I have so much on my mortgage. And oftentimes they forget, I've also got this second mortgage, this home equity loan that I also have to satisfy, stripping people, many people, of the home equity that they have, which is all that many people have in their net worth. Anyway, so I'll play this piece from Melody Wright. Take a listen to it.
But there will be absolute social unrest if we continue with these unfair practices of picking winners and losers by the government.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. A few days ago, an article appeared in the Financial Times revealing that, quote, last month, the government-sponsored mortgage finance agency Freddie Mac filed a proposal with its regulator, the Federal Housing Finance Agency, to enter into the secondary mortgage market, otherwise known as home equity loans. The article's author, Meredith Whitney, claims that if approved, this could begin to unleash almost $1 trillion into consumers' wallets. By the autumn, it could be on its way to $2 trillion. That would be a tremendous stimulus to the economy, but is it a good idea? Putting aside for a moment concerns of its potential inflationary impact, the global financial crisis was a credit crisis triggered by bad housing loans. Would allowing for the government-sponsored entities like Freddie Mac to unleash a flood of new loans risk repeating the sins of the past? For answers, we're fortunate to turn to mortgage lending expert and housing analyst Melody Wright. Melody kindly made herself available despite being in a location with poor internet connection. But despite some challenges with the video quality, the audio is just fine. And trust me, folks, this is a discussion worth listening to. Melody, thanks so much for joining us today.
Thank you so much for having me, Adam.
Hey, it's such a pleasure. Thank you so much for dropping everything when I called you to ask if you could comment on this new article. You're joining us from a remote location. The connection isn't perfect visually, but hopefully folks can soldier through that. All right, look, lots to talk about, but I know you've been chewing on this recent article. Let's start with the punchline first, if we can. Is this a good thing, a nothing burger, or is this potentially like a colossally bad idea?
The first thing I want to say is that one thing most people don't know is that we've already had equity withdrawal. And so people don't talk about this, but the forbearances that were taken out, the over 8 million people that took those out during COVID, actually the way they resolved that is they put all of those missed payments and a non-interest bearing lien at the back of the loan to be paid off when either they pay off the loan or they sell the property. And so nowhere have you seen in the media talk about these outstanding balances. I've also tried to understand whether the Fed is tracking them, and it does not seem so. And so I just kind of want to say, even before we get started on this conversation, that we've had over 1.5 million borrowers already take some form of equity withdrawal that's not really being tracked. And so, and go ahead.
Well, I was just going to say, just to make sure I and the audience follow, it's mortgage equity withdrawal, not because they went to the bank and said, I want to take out a mortgage equity loan, because of the forbearance, the bank said, look, you just don't have to pay us for this period of time. And what you would have paid us, we're just going to tack that on to the end of the loan, so that when you have to pay it off, you're going to have to pay us that extra stuff that you haven't yet.
That's correct.
Okay.
That's correct. And we're starting to see the first, social media posts about people being very surprised by this when they go to pay off their loan. Now, regulations would have said that they should absolutely get a monthly billing statement that tells them what that combined loan to value is. But servicers' technology is ancient, late 60s, early 70s. Nothing has really changed. And so that would have been very difficult for some servicers to affect. And in fact, the CFPB, or the agency that oversees mortgage, kind of said to the servicers, we're going to give you a little leeway. We know this is hard. Do your best. So we are just now seeing people being surprised by this on social media posts. We're going to start to hear a lot more, because everyone thinks that people can walk out tomorrow and sell their home and kind of garner all of this supposed untapped equity.
Okay, I've covered this before. David McAlvany does a podcast, so it's an audio podcast. So I want to play a few minutes of it. And he talks about the idea that we're trying to raise money. We've got a ton of debt, and well, who's going to buy our debt? So the more buyers we have, we prop up the value of that debt. So he says Janet Yellen, Treasury Secretary, is going around the globe trying to get buyers for our debt. Some of the buyers, namely China, I don't know about Saudi Arabia, but China for sure, has dropped off. They've been selling our debt. So she's going, and so the presumption is that if we've got more and more debt, that we need to at least keep the people who are the countries who are buying our debt in place, and then get more buyers for the added money we have. We're getting 34 trillion now. So the more that becomes, the more buyers we have to obtain. If you're a foreign country, a country outside the U.S., and you're looking at our debt, and you look at the chaos going on in our country, look at our government, Congress can't get along with each other, and the president, and then we've got all kind of social unrest in our country. We got a immigration problem, on and on. You just look at it, and companies are struggling to get growth. I'm not talking about the Magnificent Seven, but many companies below that are struggling for growth. And you look at the entirety of our country, all of it, positive and negative, and you say, do I want to really buy that debt? Yeah, they have the ability to tax the people, they have the ability to collect on it, but is that really the best place for my money, given what they're going to pay me? I don't know. Apparently, there is a challenge in getting buyers for our debt, so she's going around trying to sell that. Meanwhile, China is selling our debt. They are selling our treasuries. He quotes the number. I don't remember the number. I won't quote it. Selling that much in treasuries, and what are they doing with it? They're turning around and buying gold. Selling treasuries, buying gold. Both are defensive assets, but why would you sell treasuries and buy gold? You don't have faith in the United States of America, or for that matter, any other country. And China has been accumulating gold. Gosh, I go back about 10 years ago. And no, they don't report how much gold they have. At that time, it was estimated that they had about 6,000 tons of gold. But they've been buying at least 1,000 tons a year, maybe more. Adding to that, which their currency is garbage, but to legitimize their currency, and it's earned them a seat at the IMF, International Monetary Fund, because I think they're currency is a little more credible by having more gold behind it. How much gold have we added in the last 50 years? From everything I can read, we have not added 1 ounce of gold to our supply of gold at the New York Federal Reserve Building or Fort Knox. But China and Russia behind them and India behind them have been adding as much as they can buy every year. And by the way, their citizens, the citizens of China, Russia, and India, are also buying it, and they pay a lot more for it. Why do they pay more? They pay more because our currency is the reserve currency. Our currency is strong against theirs. So for them, relative to their currency and the value of value of their currency, it represents more, a bigger price to them to buy an ounce of gold or a bar of gold or whatever. But they still buy it because they know that their countries, the paper in their countries can become worthless. And they get it. It is estimated that in the United States, only about 3% of the people own 1 ounce of gold or silver, investment grade, quality grade. 3%. 97% own nothing. So if you go out and buy an ounce of silver, you're in the top 3%. That's the way I think of it. But so anyway, China, as a country, they're selling our, almost simultaneously, selling our treasuries and immediately buying gold. It tells you something. Think about it.
You know, Janet Yellen now is having to run around the world trying to beg people to buy our treasury bills. The rest of the world's a little concerned about our inflation.
Well, that's right. And so you've got both on the national team. Powell, he's moving basis points around, pledging to destroy inflation, justify a lower interest rate environment. Yellen, on the other hand, scurrying around the globe, seeking support for the treasury markets to avoid the inevitable rise in rates should we lose our largest investor base in treasuries. And that's a real concern. If you're going to run the same deficits, you've got to have somebody who's stepping in to fund those deficits and lend you money. If you're going to increase your deficits, you at least, at a minimum, have to maintain the old buyers and then find a new source of buyers as well. In this case, we are in fact raising the deficits, and we're beginning to lose our old buying crowd.
Well, the Jedi mind tricks aren't working on the Chinese anymore.
No. The most recent TIC flows show China quietly letting go of another $23 billion in treasury holdings to a level last seen in 2009. We're about $755 billion. That's the new total treasury holdings by the Chinese. I think the peak was just shy of $1.2 trillion in 2017.
Well, and they're raising liquidity and doing something with the liquidity, Dave. And we're seeing premiums on the Shanghai Exchange for gold, at $135 over bars?
At its peak. Now, they're probably closer to 35 today, but they will go as high and have gone as high as $100 to $125, $135 an ounce. So just note to self, Chinese selling of U.S. treasuries and buying of gold is not something to ignore.
Right.
Is it a coincidence that these are happening at the same time? It's unlikely. Some argue that the Treasury selling is more of a shift to agency paper, but that ignores how 2022 marked a dramatic shift in trust within the reserve asset community, including China.
But is it any surprise when we're actually reallocating people's money if they're not popular with the worldview that's being presented?
Yeah, Euroclear, which is based in Belgium, was the custodian for most of the Russian reserves, which were seized at the behest of the U.S. Treasury. Think about that in terms of whose law is Euroclear subject to? Is that EU law? Is that Belgian law? Is that U.S. law? It's a fascinating construct.
Those Russian assets would be mine now. They're mine now.
So Euroclear is the custodian for the Russian assets. They're seized as the U.S. Treasury instructs them to. There's also Clearstream in Luxembourg. Combined, those two entities custody $50 trillion in assets. They're sort of like the biggest banks you've never heard of.
That's a lot of
Should I say that again?
50 trillion.
Trillion
Wow.
in assets. Well, gold is not a reserve sitting in a European entity, easily poached when sanctions or other forms of pressure need to be applied. The latest form of warfare is what you see unfolding. It's economic in nature.
Well, and if you can't trust the person that you're dependent on, you just go somewhere else. Gold is that somewhere else.
So gold is control.
Yeah.
Gold is a workaround for a system deemed to be biased and dangerous. And if you step out of the liberal democratic compliance, you can expect to get hammered. So gold gives you an opt-out, a workaround for sort of liberal democratic non-compliance, if you will.
Okay, I want to switch gears. Now, I've talked about some issues, some problems with, our economy. We talked about commercial real estate or the China selling our treasuries, etc. Now I want to switch and I want to give you a positive view. So I'm not saying I'm all over the place because I'm not. I don't look at it that way. But I want to give you different perspectives from people who I think are credible. So if you are looking for a positive perspective on the market, I'm going to give you this next one, which is from Ed Yardini, Yardini Research. He's very credible. And he makes the case for the fact that the market is solid and is going up from here. So he thinks prices will escalate and head higher even this year, next year, and even the following year. And he does it based on his estimation of earnings, which usually drives stock price. So take a listen to Ed Yardini.
Joining us now, Ed Yardini. He's the president of Yardini Research. It's good to see you.
Thank you, Scott.
What a remarkable turn, huh? Since we're down 5% or so on the S&P, wondering whether we're going to have a 10% correction from there. And here we are, less than 1% away from another new record high. What should we make of this?
Well, it's clearly still very much of a bull market. I thought we could have a 5 to 10% correction. We had something a little bit over 5%. Looks like we're not going to have anything like 10%. I think what we make of it is that the economic outlook remains really quite positive. I think inflation is going to continue to moderate. I think the economy is going to continue to grow. And I think that means that earnings are going to continue to head up, probably not to a new high in the first quarter when all numbers come out. But I think over the next couple of quarters, we're going to make new record highs in earnings. So I see the market moving higher.
I mean, let's kick earnings around, if you would.
Sure.
Because I know where the outlook is, but if you look at what just happened in earnings season, and it's for all intents and purposes over, the growth was all from the mega caps, right? I mean, what are we going to do? Less than 5% total earnings growth, maybe around 5%. But the majority of that really came from a very, very select group of stocks. Why should we believe that that's going to turn?
Well, we are quite optimistic on overall corporate profits. Last year, they came in at $222 per share for the S&P 500. We're thinking $250 this year, $270 next year, and $300 in 2026. And the reason for that is I think profit margins are going to continue to expand to all-time record highs. We have seen profit margins going up, and you're absolutely right. Some of that leadership and higher profit margins have clearly been from the mega cap names. But Scott, it is what it is. I mean, we're talking about roughly 30% of the S&P 500 market cap being dominated by eight names, and they're not going away. And they're going to continue to be an important part of the market. We got a forward PE of about 21 with them, and we got a forward PE of 17 without them. So the market doesn't look cheap when you look at the overall market, but then you got to consider what you're getting for your money, and you're getting some pretty amazing companies.
Now, finally, I'm going to give you a guy, David Hunter. He's a contrarian macroeconomist. So I want to emphasize contrarian and macro. So he's been on Wall Street for decades. He is highly regarded. I've researched him as far as I can determine. He is viewed favorably. He has made a number of predictions. Keep in mind, they are contrarian and they're macro. but he's made a number of predictions, both on the positive side of the market and on the negative side of the market. He's not just all negative or all positive. And that's why I want to kind of play him after I've played some of each. And but it's an interesting thesis that he puts forth, one of which is that he believes that the market is headed significantly higher from here. He uses, I don't think it's in the clip I'm playing, but it's in the entire video, that he believes the market is going to go up about 40% more from here. And this is what is called, if he's right, this is what is called the final blow-off, where you suck in the weak investors, the unsophisticated investors, and they think it's easy to make money in the market. And we saw this in 1999, classic example. And so he says that's what's in front of us. Now, is that going to happen this year? I think he says by this year, that would be a lot. So I will say, because he's macro, I'm going to suggest that it's longer than this year. Maybe it's into next year. I don't know. And I don't think he knows. But if you said from a macro perspective, that is the case he's making, I would be careful in putting too much of a time frame on it. From there, he says, then we're in for an 80% crash. That's not a correction. That is an absolute horrific crash in the stock market, not quite, but almost rivaling the Great Depression or the stock market crash of 29 to 32. And from that, we will have a global recession. I don't know if it would be a depression because that's 10 consecutive quarters, but at least 2 consecutive quarters. So somewhere between 2 and 10, I'll say it that way, global recession. It would be terrible for everybody. It would be, I mean, jobs, homes, so many issues that people would face if that is the case. So positive in the short run, negative. And he gives some rationale behind why he says what he does. And because of his track record, which isn't perfect, but it is credible and has been attractive on Wall Street, I would say, think of it this way. We're in for a market that is going up in the short run and will have a steep decline thereafter. I personally avoid putting too much a time frame on it or percentages. Just say a big rise and a big fall. That way, you're probably going to be closer to being correct. So, but anyway, take a listen. I will attach his video, the entire video below, and as I will the others, including McAlvany, and you can listen to it and judge for yourself. But what I say to people, I say this many times, is be prepared. Be prepared for that to happen. A lot of people are not prepared. They are invested fully in the stock market. They have no defensive strategy, no method to get out of the market or to in any way minimize that risk. And if you said bonds, I would say, look at the last 4 years. Where's your protection? It's not there. So what happens if bonds collapse at the same time? Interest rates go up and bond yields go up and bond prices collapse. Could entirely happen. People didn't think that was going to happen in the last 4 years, and it happened. So I would say those people who use that traditional method, be careful. But you need something to protect you if he is correct. Think about it.
David, welcome back to the show. Always good to see you.
Hey, David. Great to see you again.
Great to see you. Let's just start with your call first that you made on my show last summer. You said that the stock markets will get a major melt up before we get a meltdown. And we can walk through your thesis again for the audience who hasn't seen that episode. You can click up here or leave the link down below to revisit David's call from last year. But you said that we're going to get a melt up to potentially 6,000 to 7,000 points on the S&P 500. Now, we did get a sort of melt up. The S&P continued to rally. Like you said, we didn't hit 6,000 or 7,000 yet. So my first question is, are we still going to get that level? Is that still your call?
Yeah, that's definitely still my call. In fact, I've I've dropped the 6,000 part of that range, and I've back in January, and I raised my target to, or had my target moved to 7,000. So I don't think I need that range anymore. I think my work shows that we are going to see the upper end of that range. So I have a target of 7,000 for the S&P, 23,000 for the Nasdaq, 55,000 for the Dow, and the hardest one for people to believe probably is that my target on the Russell, which had been 3,000, I've raised that to 3,300. So I think you're going to see this market, once we come out of this small pause we've had for the last month, resume its upside, get actually steeper, and a run to the top from here will be broad, include small caps and large caps, include growth and value. I think it's going to be a historic run, let's put it that way.
Okay, well, David, just to recap recent price movements, it seems that this bull rally that the risk assets have had is starting to taper off.
Yeah, so there's shorter term policy and longer term policy implications. I think basically my thesis for a global bust is that we have leverage in the system so much higher than it's ever been before, and we're heading for a downturn. So, I think when I say leverage higher than ever before, we've got 320 trillion in global debt, right? Both private and public. We've got quadrillions in notional value of derivatives, which is leverage on the markets. So, even looking in comparison to 2008-9, we are so far beyond anything we've ever seen before. Leverage works well on the way up, right? It helps enhance returns. On the way down, it really exacerbates problems.
Thank you for watching. If you have questions or comments, leave them in the comment section below. And also I wanted to comment that so many people left some wonderful comments last week when I covered the car market and how that's collapsing. Really enjoyed that. And some of you even sent me videos that supported that, gave me stories of your own that supported that. Thank you for doing that. But anyway, feel free to leave a comment if you have one. Thank you for watching.